And Charlie and I have always differed on this subject. He likes to tell me how gloomy the world is, and I like to tell him we'll find something. And so far we've both been kind of right. I would love to be born today and go out with not too much money and hopefully turn it into a lot of money.
Warren Buffett and Charlie Munger are the two most well-known investors in the world. They dominated the financial world for the last half-century with an approach called value investing. But one of them now thinks that times have changed so radically that it's almost impossible to beat the market investing in individual companies. In this video, they both give their advice for the value investors of the future.
I think value investors are going to have a harder time now that there's so many of them competing for a diminished bunch of opportunities. So my advice to value investors is to get used to making less.
And Charlie has been telling me the same thing the whole time we've known each other. I mean, we get along wonderfully because...
So we are making less.
Yeah, well, but that mostly, I think, is because it's larger.
When we were younger.
No, we never thought we could manage $508 billion.
No,
or whatever. But I would argue that there's going to be plenty of opportunities, and part of the reason there are going to be plenty of opportunities, the tech doesn't make any difference or any of that. I mean, if you look at how the world's changed in the years since 1942 when I started, you'd say, well, how does a kid that doesn't know anything about airplanes, that doesn't know anything about engines and cars, and doesn't know anything about electricity and all that? But that really isn't that's not the world changing doesn't, or new things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things. And it's that. And I would say that, well, the 58 years we've been running Berkshire, I would say there's been a great increase in the number of people doing dumb things, and they do big dumb things. And the reason they do it to some extent is because they can get money from other people so much easier than when we started. So you could start 10 or 15 dumb insurance companies in the last 10 years, and you could become rich if you were adroit at it, whether the business succeeded or not, and the underwriters got paid, and the lawyers got paid. And that creates, if that's done on a large scale, which it couldn't be done 58 years ago, you couldn't get the money to do some of the dumb things that we wanted to do, fortunately. So I think that investing has disappeared so much from this huge capitalistic market that anybody can play in, but that the big money is in selling other people ideas. It isn't outperforming. And I think if you don't run too much money, which we do, but if you're running small amounts of money, I think the opportunities will be greater.
But what difference does it make if you're an investor with a lot of money? Imagine you're managing a massive $100 billion portfolio. Your goal is to get a good return on this money, which sounds great, right? You decide to invest it in companies that you believe have the potential to grow. However, there aren't many companies worth over $100 billion, and the few that are either aren't growing quickly enough to meet your return targets or are too risky, which could lead to a significant loss. So you're left with the option to invest in hundreds or even thousands of smaller companies with lower market caps. However, this approach demands an enormous amount of human resources. When you invest billions in a company with a market cap of just a few $1 billion, your influence can significantly impact the stock's price. While it's nice to see the stock price rise when you're buying in, selling can cause the stock's value to plummet. In contrast, if you have a smaller amount to invest, you won't face this problem, and you'll have the flexibility to find smaller companies with greater growth potential. This can help you achieve exceptional returns. Okay, but it has always been like that. It's harder to make big returns with more money. But what Charlie Munger's saying is that in today's world, the way they got rich is no longer a walkable path. This creates the question, what exactly changed? For that, we need to understand what Warren and Charlie exactly did to get rich. They acquired a controlling stake in Berkshire Hathaway, a textile company. They fixed the operations at the company and then started using the company's profits to buy stocks in other businesses, more or less based on the principles that Warren learned from Benjamin Graham. So why would we not be able to do something similar? Get some money through a job or by building a cash flow business, then use that money to buy stocks in other businesses with big potential. Charlie thinks it is nearly impossible in today's world to beat the market by following this strategy. But what changed exactly? Yes, it is certainly harder to find companies with a significant discount to their intrinsic value because of the information economy we live in today. No matter where you are in the world, if you have access to the internet, you have access to the public markets, which makes the competition bigger. Yes, there are more institutions with billions of dollars and with access to the smartest minds and best algorithms to find these undervalued companies. And probably the most important change that has taken away the opportunity from small investors and given to people with big money is the rise of venture capital. Imagine you're a guy with a very promising business and want to grow it, but you need outside money to do that. 40, 50 years ago, when venture capital just started to come around, you really had two options. You either take the company public or try to get a loan from the banks to build your business, both of which are quite slow and require a lot of sacrifices. Well, not today. If you have a good business and you need money to grow it, there are plenty of VCs or rich people who are willing to give you the money in exchange for a part of your business. And you can grow the business to worth tens or in some cases even hundreds of billions of dollars without going public. Just think about Stripe. Obviously, it is very good for you as a founder, but it increases the difficulty for small investors to find promising companies on the public markets. But Buffett thinks there are plenty of opportunities to find great companies. Let's learn how.
And Charlie and I have always differed on this subject. He likes to tell me how gloomy the world is, and I like to tell him we'll find something, and so far we've both been kind of right. Charlie, wouldn't you? Will you budge an inch on that or not?
There is so much money now in the hands of so many smart people, all trying to outsmart one another and outpromote one another, getting more money out of other people. And it's a radically different world from the world we started in. And I suppose it will have its opportunities, but it's also going to have some unpleasant episodes.
But they're trying to outsmart each other in arenas that you don't have to play. I mean, if you look at that government bond market, at the treasury bill market, I mean, you've got this one bill that's out of line with the others. We bought over $3 billion of it the other day, but those are people. The world is overwhelmingly short-term focused, and if you go to an investor relations call, they're all trying to figure out how to fill out a sheet to show the earnings for the year, and the management is interested in feeding them expectations that will slightly be beaten. I mean, that is a world that's made to order for anybody that's trying to think about what you do that should work over 5 or 10 or 20 years. And I just think that I would love to be born today and go out with not too much money and hopefully turn it into a lot of money. And Charlie would too, actually. He just like he would find something to do, I will just guarantee you. And it wouldn't be exactly the same as before, but he would have a big pile.
I would not like the thrill of losing my big pile into a small pile.
Well,
I like my big pile just the way it is.
Well, we agree on that, incidentally. Okay.
Yes, we do. You're one of the most extreme lovers of the big pile.
The world is overwhelmingly short-term focused. If you're a manager at a publicly traded company, your first priority is to keep your your job. How do you do that? By beating the expectations every quarter and making sure that the price of the company's stock continues to grow. Buffett thinks that this gives you an edge as a small investor. If you don't have too much money and you are not an institution that has to report every quarter to its investors, then you can afford to be long-term focused. You can invest in companies now that you believe will do very well in the future without having to worry about volatility along the way. Also, try to find your edge in places where guys with the big money don't look. Social media. For example, at the end of 2021, these old money fashion style videos started to trend on social media, and in a lot of these videos, people were talking about the retail company Abercrombie & Fitch as a good place to buy these items, which made the stock price of the company skyrocket. So, in a way, I agree with both Munger and Buffett. It's clearly harder now to make it, because the competition is bigger. But on the other hand, we have access to all the information, and if we keep looking, we can find our edge to make money. And let me just say, the friendship these two have is just heartwarming to see.